Joining us right now is Russell Investments Chief Market Strategist, Stephen Wood. Stephen, good to see you. Thanks so much for joining us.
Thank you.
So I want to talk about broad markets, the bank earnings today, certainly. But what do you think about this deal and the M&A period for 17?
I think M&A looks to do better in 2017. We're going to see some repatriation, hopefully, of foreign earnings. The macro environment is improving. I think business confidence is improving. We're looking at multi-year high, if not well over a decade high for business confidence. So I think you're beginning to see some stars align, improving economy, improving liquidity, improving financial sector. So I think this could be good.
Has it gotten ahead of itself at this point?
Well, I think if you look at the broader market, I would say it has. We've been looking at the market in the U.S. as being expensive for 2016. It was expensive going into the election, and it's gotten more expensive after the election, obviously. So the fundamentals look okay. The economy looks okay. Financial conditions look okay. But with valuations, you can run, but you can't hide. Eventually, they are going to be impactful. And at these levels, we would ask clients to take a look at trimming back their U.S. to policy. They've done well. It's been a 7.5 great year bull market. Just kind of trim back a little bit and start looking globally.
The markets want to see corporate tax cuts. The markets want to see a rollback in regulations and tax reform on the individual side. Do you worry, because all the talk, all the chatter, all the focus in Washington so far has been about repealing or replacing Obamacare, which is a tough slog from a legislative standpoint. Do we need to get refocused on taxes in order for this market to keep moving higher?
I would think clearly we would need to do that. And there's no reason why it can't be a by-rail. I mean, we can do Obamacare, and then we can also look at tax reform simultaneously. There's no reason why that can't happen. But the market is anticipating a lot of very, very good news, a lot of almost flawless performance out of Congress, and that's probably not going to happen. So if there is some chop, some pullback, Washington tends to disappoint as much as it tends to impress markets.
That's why Steve Moore repeatedly said, focus on corporate tax reform, do that separately, get it done immediately, so you basically hand something to the country that will benefit everybody.
I agree with you. I think at this point, after the run-up that we've seen since election night, you got to see, now it's a show-me market. We need to see that they're actually working on tax reform. Do you think we're going to get tax reform done this year?
You know, actually, I think we're going to get it done, but one of the things that people are looking for is specific regulatory reform that relates to them. So, for instance, there are a lot of bankers out there who are looking for regulatory reform there. I don't think that's first, second, third, or fifth on the Trump agenda is dealing with Dodd-Frank. But are there particular pockets of the market, Steve, that you think have gotten ahead of themselves?
Well, I think, for example, the financial sector right now, I think the earnings will come in okay today. I think that things do look positive, but I think we're really going to be in that show-me state right now for financials. And this is a U.S.-centric financial rally. Europe still has a lot of issues within their banking sector, for example. I think energy space is probably run hard and probably appropriately so. But the economic data right now that we're seeing hasn't changed that much. We've been in this square root-shaped economic recovery for some time, and I do believe that there can be some marginal benefit by deregulation, but that is going to be a while. And Dodd-Frank is a very, very complex item, and I don't even think that we've written all the regulations to this point. So we're trying to undo regulations that to this point haven't even been written yet, and certainly not implemented by the Fed.
Yeah, you're right. Yeah. You're right.
Well, it's interesting. At least one sector has been left behind, which is, I think, some of the healthcare stocks, some of the drug company stocks. Comments that Trump made about drug pricing. What's your insight there? Is this a storm that's going to pass quickly? Because it's affected biotech and some of the related areas.
Well, I'll add to that.
Yeah.
How about talking about individual companies and impacting the individual company stocks? How do you feel about that, too?
Yeah, and this is what we saw with Mrs. Clinton as well as Mr. Trump, referring to specific companies, specific sectors within healthcare.
She didn't win. So
she didn't win.
She's not going to be president for the next 4 years.
But we are seeing that, and I think that right now we need to pull back and referring to specific sectors, specific industries. I don't think it's terribly helpful. I don't think we really know what this new replacement is going to be. I'm not convinced that the Republicans have a crystal clear plan going in as what's going to replace Obamacare. But then I also do look back that the scaffolding of a lot of the Affordable Care Act and where we now, the exchanges, you know, this has been a bipartisan agreement really for 2 decades on at least the blueprint of how to reform health care. But I do think there's going to be a lot of chop in health care. I think biotech, I think that is going to be volatile more than it's not going to be volatile going into 2017. If we can get even a reasonable assessment of what the Trump administration is going to do, not only on corporate but on individual tax rates, repatriation of foreign earnings, this could be very additive, not only to share buybacks but to direct investment. So this could be net very positive.
Just really quickly, though, as a strategist, as an investor, would you prefer Donald Trump not tweet about individual companies or sectors, about things that are not happening yet? Would you, seriously?
I will take the fifth on that.
I mean, look, he's not president yet, so we don't know that he's going to do that while president. But I get your point.
I have a feeling he is.
I know. I totally get your point.
We're talking habitual here. I think this is not going to end once inauguration happens.
But I think this is a new media dynamic. I mean, completely circumventing, the media channels. I mean, this really is a different way for presidents to communicate. It's like the analog of the fireside chat radio in the 1930s and the 1940s with Roosevelt. So I think that is going to be very, very new.
Let me
By the way,
ask you
excuse me, I've purchased a few stocks post-tweet, and a couple of them have come back, and I would say that's not a bad strategy. Boeing worked out. We'll see on the other.
Actually, we have a company coming on today called Trigger. We have the CEO coming on, whereas they send you alerts based on tweets that Donald Trump is making to say if you own this stock, you should know, FYI, this is being talked about right now. We're going to talk with the CEO of Trigger coming up. Let me ask you this. The bank stocks obviously have run up. This is a sector that's been the leadership in this market. They're reporting earnings today. Would you put new money to work in these bank stocks and buy these stocks today? Do you think the market focuses on some of the issues in the fourth quarter, or do they look ahead and say, okay, expenses are going to go down, earnings are going to go up in your Trump administration? What do you do for banks?
In the near term today or the next week, I would think you probably want to hold your positions right now. I think a lot of the positions have been placed. I think a lot of the move has been already priced into the market. And really for us, more than being an industry or sector analysis within the U.S., we're just asking clients to take a broader global look. If you look at Europe, valuations are extremely attractive. Their economic cycle is improving. Their earnings in cycle. We're getting long in the tooth in the United States on a wide array of indicators, and we're expensive by every measurement. So look more global, be more disciplined, and I think Europe is going to be a good place to begin that global diversification.
Europe,
yes. Yeah. And it didn't participate last year either. So the valuations relatively are still as attractive, if not more so, than they were 6 to 9 months ago.
The one thing I would say about Europe is there is a skin over that entire market called government change. And I think you've
politicians.
got in several major countries, major elections going on.
Yeah, so much going on, though, in Europe. I mean, even though the banking sector is sketchy there, you would buy Europe.
It's sketchy. Be very stock-specific, very active within Europe. North of the Alps, obviously, goes without saying. But what we've seen in Europe is that the political headline risk in Europe has been great entrance opportunities to get into those markets, even though there's been somewhat of a flat movement over a large number of years.